Welcome to The Explainer. Today, we're going to break down the playbook of arguably the greatest investor of all time, Warren Buffett. We're going to focus on the core, practical principles that have guided Berkshire Hathaway for more than half a century. And we're going to start with what might be the single most important bet of his entire career, a decision he made not in some fancy boardroom, but as a kid during one of the darkest moments in modern history.
Okay, so that brings us to our first section, a bet on America. This is really about the foundational investment that shaped his entire philosophy.
I want you to just picture this for a second. It's March 1942. The world is literally engulfed in World War II. The headlines are filled with absolutely terrifying news from the front lines. And on Wall Street, the mood is just pure panic as the Dow Jones crashes through the 100-point barrier. I mean, a level of fear not seen in years. So, in the middle of all that chaos, an 11-year-old kid sees something everyone else is missing. While these so-called professionals were panicking and selling, Buffett held a simple yet incredibly profound conviction. America was going to win the war. Look, this wasn't some hot stock tip. This was a fundamental, high-conviction bet on the entire American system. So, acting on that belief, he puts all his savings, every penny, into 3 shares of Citi's Service Preferred stock. Now, he'd later use this story to make an even bigger point. If you had put just $10,000 into a broad market index that very same day and just held on, it would have grown to over $51 million. It just proves that the crucial decision wasn't about timing the market, but about having time in the market. All right, Section 2, redefining long-term risk. You know, this early experience cemented a core part of his whole philosophy. And for any of you managing capital, understanding his perspective on risk is, it's absolutely critical.
So here's the thing. For Buffett, risk isn't what they teach you in business school. It's not about the day-to-day jitters of the market. It's not beta. It's about something far more fundamental. The very real danger that your capital won't be able to buy you more in the future than it can today. It's the permanent loss of purchasing power. That's the real risk.
And this idea, it just completely flips the script on what we're all taught about asset allocation. We're told bonds are risk-free. But for Buffett, a bond is just a claim on a piece of paper that's guaranteed to be worth less tomorrow than it is today, thanks to inflation. Stocks, on the other hand, are a claim on real, productive businesses that reinvest their earnings to grow and compound their value over time, which, in his view, actually makes them less risky over the long haul. So what's the big takeaway here? It's that for anyone managing capital with a long-term view, pension funds, endowments, your own retirement savings, loading up on so-called safe, high-grade bonds can paradoxically be the riskiest move you make. Okay, Section 3, hunting for great businesses. So if owning great businesses is the answer, how in the world does Berkshire actually find them? Well, that leads us to the hunt for value and the kind of discipline it takes. You know, the first rule is just incredible discipline. In his 2017 letter, Buffett talked about how hard it was to find good deals because prices for okay-ish companies were hitting, as he put it, nosebleed levels. While an army of optimistic purchasers was out there buying at any price, Berkshire was perfectly happy to just sit on its hands and wait. So instead of chasing hype, Berkshire runs every potential deal through this deceptively simple checklist. And let me tell you, every single box has to be checked, no exceptions. They aren't looking for a good story. They're looking for tangible competitive advantages, for trustworthy and skilled management, and of course, for a sensible price. It's a filter that just eliminates almost everything, which is exactly the point. And this, right here, this is one of the most powerful lessons in all of investing. Buffett is famous for saying he doesn't have to be an expert on every company, or even most companies. He just has to deeply understand the ones he buys. It's not about being the smartest person in the room. It's about knowing the boundaries of your own intelligence and never, ever straying outside of them. Which brings us to Section 4, the Berkshire Advantage. Let's dig into the unique structure that lets them pull all this off at such a massive scale. At its heart, you can think of Berkshire Hathaway as this incredible machine for allocating capital. You've got all these different businesses, from See's Candies to the BNSF Railway, generating just enormous amounts of cash. That cash then gets sent to headquarters, where Buffett and his team can deploy it into the most attractive opportunities they can find, anywhere in the economy. Stop and think about this for a second. This is an absolutely incredible fact. For a company with nearly 400,000 employees around the world, the corporate headquarters has just 24 people. This incredibly lean structure is intentional.
It gives managers the freedom to operate with complete autonomy, to think and act like true owners, because that's exactly what they are.
Okay, now for the other key ingredients in Berkshire's secret sauce: the massive low-cost capital from their insurance operations. This float is basically the money they hold after collecting premiums, but before paying out any claims. And because their underwriting is so good, so disciplined, they often make a profit before they even invest the money. That means their cost of capital isn't just zero, it's often negative. They literally get paid to hold on to billions of dollars of other people's money.
All right, this brings us to our final and, you could argue, most important section, the enduring investor's mindset. This is all about what it takes psychologically to win the long game.
First and foremost, it's this absolute commitment to being a lifelong learning machine. As Charlie Munger says, the game of investing is always evolving, and so you have to evolve with it. What worked in the 1950s buying those cheap cigar butt companies had to evolve into buying wonderful businesses at fair prices. The learning can never stop. And really, this goes all the way back to that first investment in 1942. Success in this game isn't about having a 180 IQ or building crazy complex financial models. It's about temperament. It's about emotional discipline. It's about having what Buffett calls a relaxed philosophy that lets you act rationally when everyone else around you is gripped by fear or greed.
And in the end, it all comes full circle, right back to that fundamental optimism. It's about harnessing the incredible long-term productive power of the economy, what he calls the American tailwind. It's not about trying to predict the next quarter. It's about having an unshakable faith in the next several decades of human ingenuity and progress.
So that leaves us with one final thought for you to chew on as you manage your own portfolios. In a world of constant noise and frantic activity, could it be that the ultimate competitive advantage is simply patience?